Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hi, I'm David Bourne. My top stock pick of the day today is Rocket Companies, symbol RKT. Now, you've probably seen Rocket Companies on television. They are the nation's largest mortgage lender, and they also do all branches of personal finance. So in addition to mortgages, they do auto loans, personal loans. They have a real estate site that's a serious competitor to the industry leader there, Zillow. They offer comprehensive financial guidance about a consumer's total debt, student loan options, consumer debt, and advice for improving credit. So you're probably familiar with the idea that Apple has an ecosystem of products, meaning that once you buy an Apple product, you're much more likely to buy another Apple product, more hardware to go with it, or an app, or software, or content, or something else from Apple. So it sort of keeps you in the fold of buying the products from the same company over and over again. Well, Rocket works very much the same way. Once you're in the Rocket ecosystem, it makes it very easy for you to expand from just the original mortgage or auto loan product that you had to many other products that the company sells. Now, of course, their biggest business is still mortgages, and the mortgage market is booming right along with the real estate market lately. Now, rates hit all-time lows last year. As a matter of fact, just about a year ago today or yesterday, the 10-year Treasury hit its lowest rate ever of just 44 basis points in yield. Now it's back up around 1.5%. Mortgages rates for a 30-year mortgage went to well below 3%. Now they're a little above 3%. So they're rising a bit, but still historically very, very low. And everything we know from the Fed and Chairman Powell is that those rates are not going to go much higher. Chairman Powell has been reiterated that the Fed has virtually unlimited bond buying capabilities and is not going to let the economy sink for want of bond purchases. So I think we're going to see mortgage rates in this range for quite a long time. Now, the mortgage market in the United States is about $3.5 trillion a year. It was roaring in 2020. They did $1.3 billion in mortgages just in the third quarter of 2020, right as consumers were taking advantage of those super low rates. Now, one thing I want to mention here is that the traditional mortgage market is run by brokers and salespeople, or the first interaction with a customer, and they pretty routinely get a commission of about 1%. So remember that we're talking about a sales commission of 1%. So Rocket in the 2020 year did about $320 billion worth of mortgages. So that's roughly 8 or 9% market share of the entire market. Now think about that 1% number. Rocket does everything in a much more automated fashion. So the mortgage origination market, which has been very hands-on, can be very easily automated, and it saves those significant costs and sales commissions. So 1% savings on all of the loans that Rocket did is like $3.2 billion in savings. So that's pretty significant. Now, Rocket, it trades at a forward PE of just 11x, and they've only had 2 quarters as an independent company. This is a spinoff from Quicken Loans. So as a public company, they've reported twice, big beats both times, and the Zacks consensus has been increasing for the current quarter, the next quarter, full year 2021, and full year 2022. And recently they announced they were going to pay a special dividend. So now this is a company that's probably not going to pay a regular dividend anytime soon, but they spit out $1.11 to shareholders. It just paid, I think the ex-date was a couple days ago. And so that's almost a 5% special dividend, just as a bonus of return of cash flows to investors. So that kind of behavior is pretty significant in terms of the total return that you can expect on a stock like this. Now, there's one final piece of the Rocket story that I have to address here, and that's the Reddit Robinhood type trade. So Rocket was briefly one of the darlings of the day trader crowd, where stocks are talked up on electronic message boards and everyone piles into a stock at the same time. So we saw a huge spike price from the low 20s all the way up into the 40s and then essentially right back down. And we've seen this with a number of stocks. Obviously, GameStop is the most famous, but there's a number of other stocks that get popular with that crowd, see a price spike, and then a fairly quick reversal. Now, that's not a reason to buy a stock. I don't believe that there's any fundamental value to a group of traders like that being interested in a stock, except that it does provide a certain amount of backstop for a stock. So if you have a group of traders that are enthused about the company, knowing that they are going to buy the dip means that that stock can probably, the share price can weather a little bit of bad news because there is a ready and willing group of people who are going to buy up the shares. And then the second part is that those traders often also are big buyers of options, especially out of the money call options. So if you're the kind of investor that wants to buy a stock and then sell calls against your stock, those options are trading at pretty attractive implied volatilities. You can sell calls at a much more attractive rate because there is this ready and willing group of buyers of the options. So that's another opportunity for Rocket shareholders. So all in all, we've got a great solid business, incredible market share, a set of financial conditions that seems lined up for success for the near-term and long-term future. And that's what makes Rocket Companies my top stock pick of the day. Now over to you, Nina.
Thanks, Dave. I'm Nina Mishra, and my pick today is Shopify, ticker symbol SHOP. Now, we have seen a sell-off in some of the best performers of last year, and Shopify is one of them. And that is because investors are rotating to some of the areas which benefit from reopening. And I think that gives us an opportunity to own some of the stocks which did pretty well last year and which have been benefiting from the trends which have been accelerated by the crisis. But these are some of the secular growth trends which will continue even after this health crisis is over. And one of the areas that may continue to do well is e-commerce. And we know that millions of consumers were stuck at home, so they were buying online, but consumer preferences and habits change. And some of those habits may become permanent. So that is why e-commerce is an area which looks very bright, and it may continue to grow even after the crisis is over and we return to normal. Now, Shopify, which went public in 2015, it's a relatively new company. Its shares are listed both on the Toronto and the New York Stock Exchange. It provides businesses a number of tools to digitize their operations. And smaller businesses in particular, they do not have a lot of presence online. Those smaller businesses, they are now digitizing their operations. They are moving online at an incredible pace because they want to survive in the new normal where consumers want to shop online. Now, according to Shopify, it has about 1.7 million total merchants now which use its platform, and that includes some very big ones and many, many smaller companies. Now, the company has been expanding its partnerships with social media platforms too, including Facebook and Instagram, Pinterest. It is building a warehouse and logistics network to compete with Amazon. And it recently expanded its checkout system on Facebook and Instagram. So customers will be able to use the Shop Pay system to complete their purchases on the social media platforms. And according to the Wall Street Journal, social commerce spending is expected to rise 34.8% in the US this year to $36.09 billion. And that is going to help companies like Shopify a lot. Now, to learn more about, let's go to Zacks.com and look at some of the charts and other details. So the first chart I wanted to show the table is the detailed estimates, particularly revision after its latest earnings report, which was much better than expected, and the company beat both on the top and bottom lines. And you will see that analysts have raised their earnings estimates for the current year and the next year significantly after the earnings report. Now, I also wanted to show the price consensus and EPS surprise chart. You will see that it's a beautiful chart. The company has never missed since it went public. Of course, the price performance has been parabolic over the past year. But if you look at the 52-week high and low, then you will see that the stock is currently trading significantly below its 52-week high, which was almost $1,500. So this gives us an opportunity to buy this stock at a reasonable price now, given its excellent growth potential. And of course, the company will not be able to repeat its performance and revenue growth of last year. But if you look at their investor presentation by going to their website, you will learn a lot of interesting detail. And the chart which I liked a lot is this one. So the current share of Amazon in the US retail e-commerce sale is 39%. Shopify is below 9%. So I think the company has a lot of growth potential, even though the shares have done quite well over the past year. But there is, for long-term investors, the shares still look attractively priced. Thanks for watching. In full disclosure, I own shares of Shopify in my personal trading portfolio. Make sure to check out zacks.com/promo for an interesting offer, and make sure to subscribe to our videos so that you do not miss anything. And we will see you next week.